Bilal Muhammad, Monday, 4 September 2017. More on DPHJSG. Source: GYG plc. International veterinary drugs firm Dechra Pharmaceuticals LLC (DPH) has undoubtedly been one of the stock market's great success stories over the past decade or so. Rapid growth and worldwide expansion have transformed the Norwich-based firm into a global business now valued at more than £1.8 billion. Hop on board as profits have soared, so too has the FTSE 250 firm's share price, rising from lows of just 43p in 2003 to today's record highs of 1,995p. That's all well and good for those who have kept the faith in the company since those earlier years, but what about new investors? Is it? International veterinary drugs firm Dechra Pharmaceuticals LLC (DPH) has undoubtedly been one of the stock market's great success stories over the past decade or so. Rapid growth and worldwide expansion have transformed the Norwich-based firm into a global business now valued at more than £1.8 billion. Hop on board as profits have soared, so too has the FTSE 250 firm's share price, rising from lows of just 43p in 2003 to today's record highs of 1,995p. That's all well and good for those who have kept the faith in the company since those earlier years, but what about new investors? Is it too late for them to hop on board? This morning the business announced its preliminary results for the year ended the 30th of June, giving both existing and would-be investors plenty to cheer about. The group posted a 45.1% improvement in full-year revenues to £359.3 million, with an even more impressive 54.9% rise in underlying pre-tax profits to £77 million, from £49.7 million just a year ago. Animal welfare: I don't see any let-up in growth for Dechra. Animal welfare is being taken ever more seriously, not only in Western countries, but also in the developing world. So not only is the company continuing to launch new products, it's also pressing ahead with plans to expand its geographical reach. For me, Dechra remains a good long-term buy given the potential for further growth and expansion. From a valuation perspective, a forward P ratio of the 27th of May look expensive, but I believe it's a price well worth paying given the healthy outlook. Out with the old. Another Cheshire-based firm reporting today was Johnson Service Group LLC (JSG). Half-year figures for the textile services business revealed another strong performance, with revenues increasing by 19.3% to £138 million, driven by strong organic growth of some 4.8% and a full 6 months of trading from the acquisitions completed in 2016. Adjusted pre-tax profits increased by 23.5% to £16.8 million from £13.6 million after net finance costs of £1.8 million, which were £100,000 lower than in the previous year. In a separate statement, the AIM-listed group announced the departure of its CEO, Chris Sander, who after 33 years will be retiring in the first half of 2018. It seems Mr. Sandler is leaving on a high, with the business in excellent shape and very well placed for continued growth. More focus: the decision earlier this year to forsake its 200-year-old Johnson Cleaners business was a bold but necessary one in my opinion. By the company's own admission, the dry cleaning market has been challenging in recent years, and the disposal leaves the group free to concentrate on its high-margin textile rental businesses. There's still plenty of opportunity in this market for both organic and acquisition-led growth, and I see a P rating of 17 as a very reasonable price to pay for what is now a much more focused business. Bilal Muhammad has no position in any shares mentioned. The Motley Fool UK has no position in any of the shares mentioned. Views expressed on the companies mentioned in this article are those of the writer, and therefore may differ from the official recommendations we make in our subscription services such as Share Advisor, Hidden Winners and Pro. Here at the Motley Fool we believe that considering a diverse range of insights makes us better investors.